Today we'll be talking about All Eyes on Fed, and I just found this picture, thought it was pretty funny that Powell was channeling his inner Bernanke, where he said subprime debt is contained right before the whole housing bubble collapsed, and Powell is now saying, there's no inflation, or if inflation happened, it's not going to be a big concern. So I thought it was pretty ironic that the chairman always have to avoid showing the problem right before the whole thing blows up. So these are the topics we'll be going over today. So none of these are investment advice. Please do your own research. And I apologize in advance. Some of these are very dry topics, and I don't think I have the full knowledge of the whole picture either. And if there's anything that I, misspoke about that is just wrong, or I didn't get the concept correctly, please let me know. These are very complicated topics, some of them. So as expected, the 1.9 trillion stimulus bill has been passed. Obviously, it included a lot of third-party interests. That's why it pays to be a politician. You can help your friends out when they vote you in, kind of thing. And they're already discussing the next one, and it looks like it's going to be an infrastructure one, something that Biden has been very strongly vocal about during his campaign. And there's a famous saying, you never let a serious crisis go to waste. And what I mean by that is that there's an opportunity to do things that you couldn't do before. And this is from one of the administration elected from Obama's administration. And what it means is, when a crisis happens, is, now all of a sudden you have excuses to do all these, pass all these crazy stimulus bills. And what happens is, okay, yes, you think people are getting like the 1,400 stimulus checks, but actually look at how much money is being sent to other parties. So to public, you're saying, hey, we're giving you money, but what they don't know, what the public doesn't understand, is a big portion of it is going to like your friends or people who helped you along your campaign with like big political donation. That's why big government is so scary, because the invested interest to just take money from really it's just money printing here, because the Fed's going to finance it, and just giving let's say they print out $100. So they take the purchasing power away from people, but they give like maybe $40 back to the people and 60 to like their third-party interests. Like, you're losing. You're not gaining anything here. And obviously, money printing doesn't help long-term economic growth, because you can't print purchasing power. You need production. You need investment in productivity instead of just more spending, and you can't print your way to do it. Now, a good short example, like if you just look at the 1920s recession and the 1930s Great Depression. So in 1920s, unemployment peaked at 11.7% in 1921 after the stock market crash, but it gradually dropped to 6.7 and then 2.2 in 2 years. And during that time, government cut spending from 1919 of 18.5 billion to 6.4 billion in 1920, a 65% cut. And they cut taxes. And what that did was they cut government spending and they cut taxes. So, the budget is still balancing, and they actually had a budget surplus quickly after. And what that does is you remove government away from the free market, and you allow the free market to function where the prices deflated, but people lost jobs, but prices came down because demand came down and resources were effectively being allocated to areas that they were needed, and then people were able to, and interest rates went higher, where people started saving more instead of lavishly consuming, and that's how the economy quickly recovered. And that's why you don't really hear about it, comparing to, obviously there's still the the fact that later on when the Fed came in and they cut interest rates later on, that helped fuel the 1929 stock market bubble, and also helped contribute to the 1920s roaring 20s. But the idea is in any crisis, you don't want to increase government. You want to cut government. You want to cut taxes. Let people save more and contribute to productivity. Comparing to the 1930s, so 12 months after the stock market crash, unemployment never reached double digit. It peaked at 9%, meaning the 1920s were a much severe recession than the 1930s. But and it was falling to 6.3% by June of 1930. However, that's when the government stepped in. Within 6 months, unemployment shot up to double digit, peaking at around 20% in 1932, and it stayed there for 23 consecutive months. And unemployment stayed above double digit for the whole decade. And if you just look at that, so meaning 1920s, it was a lot worse. But because government didn't intervene, the economy, it was a very severe but sharp recession. In 1930s, the government came in and thought, oh, we have to do something. And what happened is they delayed the whole process of the recession, and it made it worse. And the idea is recession is a cure, not a disease. It's a cure to an overheated market, and you have to let it happen. The more you try to delay it, the worse you make it. And that's kind of what we're seeing right now, where ever since the 1930s, the Fed and government has always been thinking, oh, we have to cut interest rates, we have to increase spending, but it's actually quite the opposite of what needs to be done. But so all we're doing is kicking the can down the road and generating a much bigger problem rather than accepting the cure. So all eyes on Fed. So this is the bigger area that I think it's more dry topics. So SLR, the supplementary leverage ratio, this the Fed push out an exception where this normally it can only include like deposits with the Fed, where the banks, they hold money. So you put money into a bank. The bank doesn't just hold that money in their vault or in their system. They lend a portion of it out, but then a portion of it has to stay with the Fed or central bank, and that's their reserves. Well, what the central bank can do in terms of monitoring the leverage the big banks have, or the commercial banks have, is by tweaking this leverage ratio. If they reduce the reserve requirement, then the banks can lend out more. If they increase it, the banks can't lend out as much. So that factors into currency and circulation and velocity. Now, what the exemption is they pushed it out saying, oh, instead of holding cash, you can put in treasuries. And that exemption is expiring in March 31st. Now, why does this matter? Now, right now, they allow the big banks to hold treasuries as part of the reserves. So what the big banks are doing is they're buying a lot of short-term treasuries, and they're holding it with the Fed. And if they hold too much, they will they'll incur penalties. And why is this important? By being able to hold treasuries with the Fed, they're buying up a lot of short-term treasuries, and they're unwilling to lend it out because they know the rate that they lend out at is not worth the risk. But by buying short-term treasuries and holding it with the Fed, they supplement the reserve requirement, and they can earn some short-term interest on it. And in their eyes, it's risk-free because it's backed by the US government. And it beats risking to lend it out to, you know, into the market, because the chance of those people not repaying is too high, and it's not worth the risk of return, which is the interest rate return for those securities. And so what if the Fed doesn't extend this? What we could see is we will have, so the red line right here, this is the deposits other than reserves. So these are the treasuries, and then this will happen is this amount, we could see it falling, while the currency, the deposits, we could see that shot up. And what that will do is it will increase the amount of currency in circulation, because now you can't hold treasuries, and those will just expire, and that will rampantly move into the market, because you can't hold too much cash or else you'll incur a penalty. And so velocity could quickly pick up here, and that means also increasing inflation. So the Fed doesn't necessarily have to print any more in terms of the total balance sheet, but all they have to do is just increase velocity, and how they will do that is through the private banks. Next up, yield curve control. So that idea has been floating for a long time, and I think eventually it will have to come out. And it's just another name for QE, but what happens is instead of targeting the total amount to print, which is the expansion of the balance sheet, what they will do is they target the yields on US treasuries, but they still do it by buying up bonds with printed money. So two scenarios. One, they prevent yields to shoot higher, so they'll come in before the market collapse further. Or they let the market collapse and then they come to the rescue to avoid a complete implosion. And I think that's really risky, where the market is already losing confidence in the Fed, and they might not believe it when the Fed comes in next time. Who knows? But I think we'll see next week to see what Powell will do. But the market is expecting the Fed to come in, because they're already rallying right now, regardless of yields actually making a new high since the pandemic. Obviously, you still have the impact of the stimulus bill, but this is a continuous development that we will see with the press conference on Wednesday. China's action. So as mentioned before, China has a tightening policy that is not allowing US to use China to deleverage. And how does US deleverage? They use inflation by exporting it via treasury. So if you think about it, US, they have a trade deficit. And how does that come about? So that means they import more from the rest of the world than they export. And how do they pay for that difference? They do it by US treasuries. So when other people all across the world hold US treasury because they trade with US and have a trade deficit, what happens is now US, with the help of central bank, with the Fed, they print money, they create inflation. So they're inflating their debt away, not just foreign investors, but also locally, because it impacts the dollar. So anyone that holds US dollar and US treasuries, not including tips, we'll talk about that later, regular US treasuries, they get their purchasing power stolen. And that's how US deleverage. And how they actually do that in sequence is they first flood the financial markets with low interest rates and printed currency, so it prop up everyone's market. And then they raise interest rate and shrink the Fed's balance sheet, so they now pull all the currency back into the US. And by doing so, they pop the asset bubbles around the world while keeping US intact. So China has realized the scheme. Russia also has, because that's why Russia has actually phased out the US dollar. But China realized the scheme. And why is this most important to China is because US biggest trade partner is China. So over the years, China has accumulated a lot of US treasuries, and they don't want to import this inflation anymore. And so what China has been doing, it's been popping its own bubbles slowly and preemptively, like the housing bubble and the stock market. So that's why they haven't been performing as well recently. And for long term, they're trying to focus on the dual circulation, where they're increasing domestic consumption and also increasing more domestic production. So they're trying to rely more on themselves, and also like have better trade agreements. And the best case for China is a slow decline of US, where China has time to slowly remove its US exposure, like continue to focus more trade for other countries, like what they have been doing with the developing countries, where they take raw materials and then they help them build infrastructures. But if US implodes quickly, all those US treasuries that China holds will be worthless. So again, the best case for China is a slow decline of US, where China can slowly, sell off the US treasuries, sell off US dollars to trade for real assets to help long-term growth. And this is the issue. That's why this will continue to create tensions, because US is trying to deleverage and so is China, and you can't have both doing that at the same time. Well, at least US won't be successful when China is also trying to deleverage. If US is deleveraging, US need other countries to add leverage so US can successfully deleverage. So that's why there's a lot of conflict. So it's a long-term, very macro economics, so very interesting to continue to watch the two biggest powers to compete with each other. So we will continue to observe. So the bond market update. So as mentioned before, the 10-year and 30-year both made a new high since COVID pandemic. And for the February CPI, year over year is 1.7. So you can see that even with a 10-year treasury, real yields are negative. Let's not even mention like below 10-year, like the 1 year, 2 year, 5 year, or like a few months ones. So real yields are still negative. So, and with inflation continue to increase, and if the Fed comes out to try to cap bond yields, I think real yields will continuously to go more negative. TIPS will then continue to be the favorite treasury with inflation ramping up. I've talked about TIPS in a previous video. Feel free to check that out. And finally, the debt crisis is still looming, and possibly that might come into question in Q3 if we see a continuous rapid ramp up in Fed buying and by money printing increasing in the balance sheet. So I think debt crisis, like we already have it, but I think people will start to have questions, have concerns about it. On the stock market update, Dow and S&P 500 made a new all-time high, led by energy and the value trade. Nasdaq was actually able to recover above the neckline, like I mentioned before, 12,900. It's a key support that they can't break, because it will be a lot further downside, and looks like with the head and shoulder pattern, they're able to make above the neckline, but still continue to see they have to hold it, or the risk is to the downside. It looks like investors are expecting either the stimulus bill to actually encourage economic recovery, which again, um, you're stealing future long-term economic growth to help stimulate short-term economic recovery. Long-term, it's not beneficial, and people are not seeing it right now, or they just know that, hey, there's nothing I can do about it. Might as well try to make money as much as possible in the short run. Or they just think that because of all these 1,400 stimulus check that went out, a lot of it would go into the financial market. So yields continue to rally. So until the Fed comes in, higher yields will be expected, and I think it will continue to impact valuation. So meaning the wave of from shifting from growth to value companies will continue. So that's again really heavily impacting the Nasdaq, and it's helping Dow and S&P to outperform. So we'll continue to observe what will the Fed do and what the impact will be. Finally, we'll just do a quick commodities update. Oil, it continues to rally, and I think it's pretty intact. And because in terms as price increase, as demand are recovering, there's no increase in supply in the US. There's no willingness for additional investment in more oil rigs. And because investors, they're being put on the narrative that oil is in the past, we're just going to focus on green energy, we don't need oil anymore, so we're not going to put more money into oil, so there's less investors, and the previous investors have been burned because the oil prices went way down as US ramped up production after Trump pushed for more fracking, that they lost a lot of money. So I think they're out too. And if you actually look at the market, there's very little retail investors. Either they've lost their faith, not interested in the market because of the whole narrative, or they just lost their faith after negative oil futures last year. And finally, Biden's administration for the need of a stronger dollar and by higher oil prices that will help it, and also to slow down China. Again, these have been covered. Precious metals. So the average trader is still waiting for a nominal yield peak. They don't understand its real yield is still negative. They're only looking at higher yields. That means there's higher opportunity cost by holding gold, so I'm not going to hold it. But they don't understand that it's real yields that impact precious metals. And real yields are still negative. So that's something they will eventually have to find out. Hedge funds, if we actually look at the committers of traders report for the COMEX, they're actually now net long, and bullion banks have significantly dropped their short positions. So we could be seeing a near-term bottom soon, and we should be seeing a rally after that. Again, I'm expecting gold to make a new all-time high, 2,300, 2,400, and silver to go up to 35 to even 40, and possibly make a new all-time high if it breaks 50. I think that will still take time though. And finally, the stagflation risk is increasing. So if we actually take a look at the jobs report recently, the average hourly earnings are increasing, but the average hourly hours worked is decreasing. So meaning labor is getting more expensive, but they're being less productive. And when you have inflation, but unemployment continues to increase, and also it also puts into a pressure for more unemployment when your workers are getting more expensive and not as productive. The stagflation risk is increasing. And I think that is something that will eventually happen because we continue to pay people to stay home and not work. And with that looming on the horizon, that will be another win for precious metals. And finally, base metals, they've again impressive rally already, but I think they might catch another win when the news of, they're discussing the next stimulus bill being an infrastructure bill. So perhaps looking at copper and iron, those would be kind of what I'll look at. But again, inflation trade is in full motion, and very exciting news. Very sad it has to come to this, but we're trying to play the cards that we're being dealt. None of these are investment advice. Please do your own research.